Dow's down 700 points. Wall Street sell-off intensifying. What's going on? Bitcoin under 100,000. All kinds of stuff going on. 50-year mortgages, portable mortgages, crypto mortgages, foreclosures jumping. It's time for a sit down. It's time for a little chat. We must have a chat, my friends. We need to have a little chat. And today, I normally don't do videos during the day because I'm busy. I have a lot to do. But I had to make the exception here. And the first red flag today, we're going to talk about several things, all these things that are being discussed so far in just the mortgage world here recently. Well, first of all, foreclosures, new foreclosure starts jumped 20%. That's not even the worst statistic to see there, but we'll go through that. Of course, 50-year mortgages, portable mortgages. There's a foreclosure article we're going to talk about. Also, the startup here. There's a few different things I want to show you. The startup that's doing commercial real estate is pretty interesting. Fannie Mae ending credit score requirements. Is this a sign of the times? Is this a reminder of what happened back before the big crash? And also, we'll take a look at probabilities for a December rate cut have actually been getting worse by the day. And that has a lot to do with Fed governors out there chitty-chatting it up with different podcasters and whatnot, saying things like, yeah, we don't know if cuts are really warranted anymore. Now, this all does lead to what I've been expecting, what we've been talking about is likely to happen next year. And there is a very consistent process that the market seems to go through before we get big Fed intervention, which seems to be what's coming. So we're going to go through all that stuff. All right, so let's go first things first, get the charts out. Let's get this part over with because it is pretty ugly. All right, very, very ugly stuff. If we look at the NASDAQ here, appears to be making a pretty perfect bearish pattern, which is going to send the futures down into the 21,000 range. A lot of support down there between 21 or 22, let's say, and 21,000. I think that's likely the bounce area, but that's a long ways from here. That's a long ways from here. It's maybe 20%. So it's a lot to bite off. Tesla is trying to bite it all off today. Dude, take a little time before you rip my face off. But it is what it is. I've been saying for quite some time, for my friends who are asking about the stock regularly, this green area here is my add more zone in the 370 to 360 range, or 350 to 370 range, right there. Very likely, we've got a nice trend line. We've got a perfect bearish formation completion. We also have this former resistance, which hasn't been revisited. This was the big resistance we were dealing with for so long. But this goes all the way back to February 2025. So mid-February, so almost the entire year dealing with this resistance. We blasted through it when Elon bought $1 billion of stock ahead of the most important Tesla vote of all time. And he's the one who notched it up here. So I completely expected us to retrace all the way back through here. I did hedge it a little bit, but didn't do a great job, didn't hedge it enough. And so Tesla's having a big, big retreat today. And now when we look at Bitcoin, this is the last chart I'll show you for now. Bitcoin made the big announcement on Facebook that I was completely done with it, 113,000. And the reason was because the bearish formation was just too perfect. Now, there's influencers that I trust out there who also have been talking about a bearish sentiment being more prevalent, more likely, more probable in the coming days. I really do think we're going to at least see 85,000 on Bitcoin. And my worst case, -4, is down at 58,000. So I will be looking to start adding in probably when we hit 85,000. As soon as I see a bullish formation of any kind after hitting 85,000, I would start getting in. Even if it were a false flag and it went lower, I would just continue to add to it. I'm not going to go all in at once. But I'm not anywhere near there. I'm completely out of Bitcoin. And for all my friends who are in it and have a long-term vision, it's perfectly okay, by the way. When we see these things coming up, it's perfectly okay to just hold. If you have a long-term investment you believe in, whether it's Tesla, whether it's Bitcoin, whether it's Palantir or NVIDIA, whatever, it's perfectly okay to just hold it and not try to play these little moves. Because yeah, okay, I got out at 113, but I still have to get back in less than that for that to have worked. Like if this thing rips tomorrow up to 130, then I was wrong and I got screwed, right? I screwed myself. So playing the market, getting in and out, not really advised for most people. Stay with your long-term conviction stuff. And these charts are just really, really ugly. So I just wanted to rip the band-aid off and get it out of the way. If we look at what's happening with mortgage bonds, and this is where the concern really comes in for me, is the bond market today. It's like, okay, stock market sell off, normal, healthy, perfectly fine. It's part of the game. We're up a lot. We should be coming back. It's perfectly okay. But when we have stocks selling off at this magnitude, and then we also have bonds selling off at a pretty good clip, this is not a normal rotation. This is not a normal money rotation, okay? Coming out of stocks and into bonds for some short-term safety. Money's leaving everywhere. Everything's red. So when that happens, it's a little more capitulation oriented to me. And it is a red flag. It doesn't mean that we're going to have a massive, massive pullback here for sure. But it is kind of what happens. This is the kind of symptoms that you see. We're trying to diagnose the market here. These are the kind of symptoms that we see before there's a big capitulation. Now, that capitulation that might be incoming is probably going to be the best buying opportunity that we're going to see for a number of years to come. So I am anxiously awaiting. But in the meantime, obviously not stoked about the fact that we lost 20 basis points in mortgage bonds today. But we're still, as long as we hold in this channel right here, I'm super happy. And even if we leave this channel and come touch some of those other areas I was telling you that it was very likely for us to touch down here, I'm okay. As long as this bullish formation stays intact, I'm Gucci. But let's hope that that's the case. Let's hope that that's the case, because the last thing we need is higher interest rates. Meanwhile, we have this here. Okay, foreclosure article. Let's look at that. Okay, so foreclosures jumped 20% in October. What's going on with this? What is happening? Well, some things that aren't going well in the market, mostly sort of the slowness in real estate and the fact that we haven't seen rates really drop much. Although they've come down, they have come down, but they haven't come down a ton. They haven't come down to where people feel excited about interest rates. And this causes sort of a stagnation for people who are sellers when it becomes more of a buyer's market, especially in tighter markets where you're not seeing a lot of appreciation. In those markets, we're going to see people get upside down. We're starting to see some short sales come back because you have cost of sale to add into it. If you bought a place for $300,000 and it's still worth $300,000 today, 2 years later, well, that sounds stable. It's still going to cost you 25 grand to sell it. So, if you don't have the money, you're upside down. Now you're doing a short sale. Now you're doing a foreclosure. And that's a lot of what we're seeing. We're not seeing big, declines in real estate values, but we are seeing sort of stagnation and appreciation that keeps people from moving about the cabin the way that they would like to be able to sell it or, refinance or get out of it, or, they're not having as many options. And so that is what's causing this. So foreclosure starts, all right, which is the 90-day late range, rose 6% for the month, and they're 20% higher than the year before. Foreclosures have been incredibly small, almost a non-existent. So when we do see them start to pick their heads out a little bit, you're going to see these huge percentage numbers. They're not as scary as they sound, but they're not nothing either. Because completed foreclosures, the final phase, up 32% year over year. These are pretty big percentages, but overall the numbers are still small. Notice here, Florida, South Carolina, Illinois are the main areas that we're seeing foreclosures. These are also areas where appreciation hasn't happened quite as much, and you have a lot of new construction activity. And when you have a lot of new construction activity, resale homes don't do as well as they're competing with brand new homes and all these incentives that the builders provide and so forth. So it can get a little bit more difficult for people in some of those places. So let's keep that in mind. But this is not nothing. This is not nothing. But what this is doing, and by the way, this is certainly a part of the reason why we are seeing a big sell-off today in paper assets. This is definitely a part of it, because of the fact that the White House has gotten pretty desperate to do something for the real estate sector And it has become glaringly obvious that they aren't going to get the cooperation they're wanting from the Fed. Okay, we showed that earlier. We thought December cuts were like a guarantee, basically. I mean, this was a 90 something percent before the last cut. Since then, we've had a Jerome Powell press conference, a bunch of other Fed governor press conferences, and these bozos who have no idea what they're doing. I say that very confidently. You could get rid of all of the Fed governors and I could do the job myself. It would be so easy. The role that they play is actually insanely simple and they overcomplicate it. I don't know. For job security, I don't know. But we're down to 47% there, okay, for cuts. So obviously Trump and Powell have gone butted heads a lot about the cutting of interest rates. And Powell's been very hawkish, even though he cut rates 4 times while Biden was president and inflation was much worse. People were saying, was it political? I think it has to be. There's nothing else makes sense. The numbers certainly don't make sense. But this has gotten the Trump administration to be a little bit desperate for a solution. And so we're starting to see that desperation surface in ideas. Now, these ideas, they're not terrible ideas. They're not great ideas. I do have a great idea that I don't know how to get to these guys. It's the most obvious thing in the world, but this 50-year mortgage is not a great idea, but it's not a terrible idea in the sense that it could make payments more affordable. And being on the ground floor, I can tell you for certain, when people buy a home, it is the monthly payment that is the most important thing to them. That is the thing that they are looking at the most. Okay. It's not the only thing they're necessarily looking at, but it is the most important thing that they're looking at. What's the payment? If the payment is something that I can swallow, then I will feel a lot more comfortable moving forward. A lot of times, though, these days, because prices haven't really come down, rates are still relatively high, considering the last 5 years, let's say. And so people see the payment and they go, ooh, yikes, maybe we should just hang out for a second. And that's kind of what's going on. So the 50-year mortgage isn't a terrible idea, but it's not likely to happen. I don't think it's likely to happen. If it does, is it dangerous? Potentially. I mean, already I think 30-year mortgages are crazy. When I first started in the business, the 30-year mortgage was really catching its wind, in like the early 2000s. It had been around for a little bit, but if you go back before that too much in like the early 90s, I don't think they had 30-year mortgages back then. And, it was usually 15 or 10 years, and then they had the 20-year and then the 30-year. And everyone was like, wow, this is insane. 30 years. How am I going to be in 30 years? 50 years? I shared a joke article from the Babylon Bee. They said, they're going to force your grandchildren to co-sign. Like a 3 and a 4-year-old, like sitting there at the closing table signing. And while it's funny, it's also like pretty serious. So the 50-year mortgage, not a great idea. Is a great idea. The banks are going to like it. Banks are going to love it. They'll make a ton of money on the 50-year mortgage. Ton. But why not just make interest-only options available? If you're going to do a 50-year amortization, why not just say, hey, why pay any principal at all? If we're banking on it appreciating anyway, just do an interest-only. And that exists. Interest-only rates are higher. If you guys really want to do something, hope you're watching, just go ahead and say interest only. That's it. We'll give you a Fannie Mae mortgage, same rate. You can choose. Do you want to make a fully amortized payment? Do you want to make an interest-only payment? What does that remind you of? Yeah, that kind of stuff was happening before the crash. Pay option arms. Pay option arms was, hey, you have the option. You can pay the interest-only payment. You can pay the 30-year fixed payment. You can pay the negative amortization payment, whatever you want. So I don't like the direction of that at all. Very much against it. Very much against it. If it happens, it is what it is. Will it spark the market? It would. It would. And so that's why you're seeing kind of like, yeah, it's a good litmus test. You'll see like the people who really care and who are in this for the right reasons and who really want to give people good advice, not liking this. People who are in it for transactions to make money, they're going to love this. They're going to be like, ooh, ooh. And they'll be posting on social media, ooh, this great thing's coming. It's great for them because it will create more transactions. It's not great for the end user. It's just not. And you can do all kinds of math on this. And you can do all kinds of, well, if you just take the money you would save and invest it, you can do all that stuff. You can do that with anything. But it doesn't, if someone needs a 50-year mortgage, are they going to be that financially savvy? Come on. So, of course, CNN. Then we're talking about portable mortgages now. Okay, so this is the sort of the continued desperation. Why would the administration be so desperate? Well, they can't get things done with Powell. They can't get interest rates down until at least the middle of next year, if that goes well, which it should. And the Fed itself is being just kind of standoffish. They don't see any blood in the streets. They're not really ready to jump in and do anything. So they're going portable mortgages. All right, what in the world is this? This is a concept at this time where they're saying basically, all right, take your mortgage with you. There are a lot of logistical issues with this. It is akin to a loan assumption. Okay. So a loan assumption is when you take over the loan, when you buy someone's house essentially, but you take over the loan that they already have on the property. That's called a loan assumption. Every VA loan, by the way, is assumable. And that's one of the really cool and powerful things about the VA loan, many powerful things, but a lot of other loans are also assumable. People just don't know it. VA loans have to be assumable per the VA. Other loans don't have to be, but a lot of them are. And so this is kind of what that would be. But here's the trouble. Let's say you owe $400,000 on your current home at 3%. You want to go buy the next house. But for the next house, you're going to need to borrow $600,000. Even after you sell your current house and get the down payment. So you've got $400,000 at 3%. They're saying that you can port over, so it's portable. You can port it from here to there to the new mortgage. But then what about the extra $200,000? What happens with that? This is where the problem comes in, because shuffling this paper is not that simple. The bank is not going to give you the 3% on the additional $200,000. They're going to be way upside down on that. And if they're not going to be upside down, that's going to be because the government subsidizes, which means you and I are paying for it. That's not cool. That's not cool at all, I don't think. So what it then becomes is just like a loan assumption, where this additional money that you need you have to get a second mortgage. You can't have two first mortgages. So you're going to have to get a second mortgage. Also, this paper is going to have to get reshuffled in the secondary market somehow because it's going from here to here. And that's going to be problematic. I do not think that this is possible. And if it is doable, I don't think it's going to be that great. I think it's going to be like a loan assumption. And if you've done a loan assumption, you know it's not that great of a process. It can be great for the end user if it's a good situation. Like if you have a $400,000 mortgage, and on the new home with your down payment, you're only going to need a $400,000 mortgage. Maybe it works out perfectly for you, and you get to keep your 3%. And that makes sense. That makes sense. But most people are going to need to borrow more. And what do you do there? And I don't see, and I haven't heard any decent solution for that. So this is another good concept. Their heart is in the right place, if you will. They're trying to come up with solutions. They're trying to innovate in this really old school, business arena, real estate finance. It's just not that easy to do. It's really not. But all you would need to do, and I'm telling you right now, this does the trick. All you would need to do is incentivize sellers. Do something for sellers. Give them a tax break. Hey, if you sell your home in 2026, no capital gains tax, no limits for anybody. What? Yeah, that would be a big difference maker, because people who are looking to sell right now, they have a lot of equity. People who bought before COVID, right during COVID, right after, they have a lot of equity. They have a very low rate. That equity can become taxable in a lot of circumstances. And they have to take the higher rate, all the things, plus the move. So if you give them a bone, say, hey, we know you got to take a higher rate, but here, don't take a tax burden with you. Let's eliminate that. Let's eliminate the tax burden for you just for 2026. What would happen is you would get a lot of sellers bringing inventory to the marketplace. Would that cause prices to come in a little bit? Maybe. But what it would do is it would give buyers more options. It would give more opportunity for people to engage in a transaction. Okay. And those people who are on the sidelines, a lot of them have a lot of equity. They could take a little bit less on the sale. if that's what it meant for them to get to where they wanted to go. So that would be the solution. Now, there's one more thing, and this one, I have a lot of people asking me about this. A lot of realtors, even had a friend today send me a video. It's just a crazy video. They're just full of bullshit, to be honest with you. Someone who clearly has no idea what's actually going on here or how this works, and has a huge following and is giving people misinformation about what it actually is. So let me set the record very straight for you here. So Fannie Mae did end its hard 620 credit score cutoff. What does that mean? That means prior to this, if you had a 619 credit score, you could not get a Fannie Mae loan. Can't do it. You can get an FHA loan, a Ginnie Mae loan. Couldn't get a Fannie Mae loan. So they decided to get rid of that. Why though? Why did they get rid of it? Well, because they want to be able to approve people. Imagine you have a 619 and you're putting 50% down payment. Before, you couldn't get a loan. Now you can. They're not trying to pull a 2008. They're not trying to say, hey, anyone can get a loan, any credit score. No, you still have to have DU approval. I can't even get people with like 630s approve a DU, in decent situations. So yeah, I think this is strictly a play, and I don't have this is not a confirmed fact, but in my professional opinion, with tremendous experience in this arena, my estimation is that the reason they are doing this is because they don't want to say no to the really sweet deals. Look, if you have a 500 credit score and you're putting 50% down or 40% down, I'll do the loan if no one else will. That's a great loan. Almost no risk. Very little, if any, risk with that much down payment. They want to be able to do those deals through Fannie Mae. Lower credit score, big down payment. That's what it is that they're looking for. I can almost guarantee you. Or maybe decent down payment, really low DTI. They're looking for stuff that is really premium in that sub 620 category. Because one thing I can tell you for sure, and this is a good thing, DU, Desktop Underwriter, which is the automated underwriting engine for Fannie Mae, it has only gotten tighter. In the last few years, it's gotten harder and harder and harder, tighter and tighter and tighter. And this is a good thing because that is the opposite of 2008. That is not 2008-ish, and neither is this. So please, pretty please be careful where you get your information from. So much misinformation on all of these items. And it's a sad thing to see, but it is the way of the world these days. So we got the foreclosures rising. We're going to keep a close eye on this. Seems to be heavily concentrated in a few small areas. And just in case, this one is just a slight victory lap for me. Just in case you thought all these years I've been telling you, Wall Street wants to buy all of the homes. Here you go. This is what they're going to do. Well, what have I been saying for 15 years? Startup backed by Bezos and Benioff launched a trading platform for shares of rental homes. They want to buy rental homes and securitize them, literally like IPO it, and then sell you shares of it. That is even more bonkers than what I thought was happening, because if they can do that, then there is a way more gasoline in that arena than even I thought. And I've been the only one that I know of who's been screaming about this. There's a couple congressmen who are too, saying that, hey, these people shouldn't be able to buy homes. Wall Street shouldn't be able to buy homes. Mostly just gets buried. But this is what they're doing. This is way more aggressive. This could actually cause a problem. Remember, the crash happened because why? Wall Street got a hold of mortgage paper. They got a hold of mortgage paper. They corrupted the ratings agencies. They got false AAA ratings on piece of crap bonds, and the crash ensued. Wall Street will screw up anything. They will go in, take as much money out of it as they can, leave in their private jets, and leave us with nothing. So I don't like it at all, not one bit, but Is it something that people are going to like in general? Yeah, people are going to love this because if you have $1,000, you can't buy a house, you can't buy a rental property, but you could buy shares of a rental property and get your little rent payment, do your pro rata rent payment. So people are going to like it, and no one's going to see the evil that it really is until that day comes. And it could be 20, 30, 40 years from now. If this takes off the way that it could, based on this concept, far more aggressive than I was prepared for, then yeah, it will be everything I've been warning about. So hopefully that is not the case. Also, Trump administration wants to allow crypto-backed mortgages. So this is, again, we're talking about the White House being pretty desperate. And I don't want to say desperate is not the correct, but they're being very aggressive with solutions. Okay. Because they know the housing needs a spark. It needs a little umph, a little push. It's just stuck and it's just sort of sinking slowly into the ground. And the longer it sinks into the ground, the harder it is to move. They want to get that sucker in motion. So they're coming up with lots of ideas. Crypto-backed mortgages, if we could get that done through FHFA, if you get that done through Fannie and Freddie, crypto-backed mortgages, it's genius. It really is, because it allows people to essentially borrow against their crypto assets. And of course, it would probably only allow Bitcoin and ETH or something like that, but allows you to essentially borrow against that to buy a home. Well, that's kind of awesome, isn't it? I mean, think about it. If you're Fannie and you're giving out the loan, normally you just get the home. And now they're going to say, okay, well, hey, we're using this as well as collateral. So we're getting the house and the crypto? Because it's crypto backed, not crypto mortgages, crypto backed mortgages. It's like a real mouthful, because crypto backed implies that that's mortgaged and then you have a mortgage as well. So that is a no brainer. Get that done. Get that done. There's far less risk from a lending standpoint to have additional collateral and to just sort of normalize crypto assets, because there are a lot of people who have crypto and it's not as easy to use it in a home loan process, especially if you use cold storage and stuff like that. If you have it on an exchange, you get statements, you can do it. But a lot of people don't have it set up that way. So overall, what is this leading to? All right. So here's the big reveal. What's happening? What is going to happen? Well, we know that there are certain material facts here. Okay. And one of the material facts is that Jerome Powell is going to be done. Okay. There is no way in the world his term extends as Fed chair. Trump will nominate someone in May of 2026, 6 months from now. So it's enough time for some serious pain to take place. And that's why I'm being very cautious about everything. 6 months from now, we get a new nomination for Fed chair. Then they have to go through the Senate approval process. Once they go through the Senate approval process, and they become officially on board, then I think we start to see some things happen. Now, that could be summer, late summer, early fall next year, maybe. It's hard to say, but you can be sure of one thing. Whoever gets put in there is definitely going to be pro rate cuts. How much can they manage to get out of that? We don't know, but my expectation is that we're going to see pretty significant cuts, maybe 1% to 2%. And I think I think that's enough. I don't think we need to take it all the way down to zero. Just get it mortgages to start with a 4 and watch this thing cook on its own. Give sellers some incentive, cut rates down into the 4s, and let this thing just happen the way it's supposed to. And the market will take care of the rest. You don't need to do anything else. That's enough. But it's very likely that what we're seeing today and the setup, all this red here in the stock market, all this we're down almost 600 points. This is the NASDAQ futures market right here. It's a big, giant black handle, which is red. We're seeing things, Bitcoin dropping below support now, just looking really bad. It's very likely that because before we see really big Fed intervention, there always has to be pain first. It has to be pain. So now if you were a Wall Street market maker and you were looking at this current situation and you were thinking, okay, how does the next 6 to 12 months play out? If you really want the Fed to do something, they're going to be in position to. If you really want them to do something, they have to create pain first, and they can profit from that pain. And that is what I believe is taking place right now. I believe they're going to hit the market as hard as they can. You know, in the next several months, maybe the next 6 months, however long it is, they're gonna hit the market hard, and we'll have days where we're up, and but mostly we'll be down, right? During that time. And that's when Wall Street, that's when market makers will be buying. They will be accumulating right when it seems like it's the worst, right when everything seems really bad, but prices haven't really gone down the last few days. That's them and they're buying it while you're panic selling it to them. And then we're going to get the Fed intervention and get the and get the cuts and potentially get some QE, and then we're going to see massive upside from there. That's my guess. Okay, that's my guess just based on watching these cycles happen. The market seems to be getting ready for Fed intervention, and that can happen across the board. You can see everything go higher in that situation. Everything can go up, just like right now, everything's going down, except for oil. Oil's up 17 cents. Everything else is red. So if we just kind of think about sort of what's happening over the next 6 to 12 months, try to think like a market maker, this would make sense, right? That stuff needs to come down because we're just too high. I mean, when you look at some of these charts, and I don't mean too high, like it's not worth this, but you look at like an NVIDIA chart. NVIDIA almost got to -4, and that should have been my clue that it was done. But you look at these, that's too much. That's too much gain. I mean, how far back are we talking? This is April. In April, NVIDIA was selling for $86. Today, it's $186 after coming down $35 a share. So, we're high right now. We're high, locally high, and most likely we need to pull back before we can go higher. That's just my overall, very vanilla sort of understanding of it. But if I'm right about this, and there's a good chance I am, if I'm right about this, we've got pain, then we're going to have intervention, changing of the guard, all taking place around the middle to, let's say second, third quarter next year, into second quarter, third quarter-ish, probably, we'll start to see things get a lot better. So the question is, how do we advise people? How do we guide people on what to do between now and then? It's going to be a bumpy road. It's going to be a bumpy road. I like the fact that we're seeing ideas from the administration. I like the fact that even though they haven't come up with a great one yet, that they're trying. Hey, 50-year mortgage. Hey, portable mortgage. Hey, let's end this credit score thing. Let's take in some of these good loans with these high down payments. Foreclosures jumping is not great. There it is. Crypto-backed mortgages. Hey, let's do that. They're trying to find a way to extend an olive branch to the market to keep sort of some momentum and some sort of hope going. And I promise you, like, they knew this before we did, right? Like the White House economists, they knew that this was going on and that these numbers were on the precipice. So they're trying to get ahead of what they see as probably some ugly numbers to come out. Those ugly numbers, though, give the Fed the green light. And so ultimately, when the Fed gets a green light, what do they like to do? Yeah, they'll pull the trigger. They absolutely will. They will pull the trigger and they will do things. Okay. There's so many things that they could do. It's hard to say what they'll do. Hopefully they buy bonds and cut rates. That's really all I want. Buy some bonds. Doesn't have to be a big bond buying program. Just a little something. Buy 1 million a day. You guys don't need to buy 10 billion a day. Just buy 1 million a day. No one will want to fight that. Everyone will get on the same side of the trade as the Fed, and we'll see bonds go up and rates go down. They won't have to put that much money into it. I'm telling you, stuff isn't rocket science. That's all you have to do, just a little bit. Say the right things. When you go on and do an interview on CNBC, say, yeah, this Fed is ready to support the real estate market and economy in any way that's needed to make sure that the markets are robust and well-performing. That's all you have to say. You don't actually even have to do anything. If you just say that, then the market will be like, yeah, well, we're not going to take the other side of that trade if that's what they're saying. And they don't even use the fact that they could do that to their advantage. They could literally be all talk. It would work because no one wants to fight the Fed. That's the number one rule on Wall Street is you don't fight the Fed unless you want to go broke, jump off a bridge. If you do, then fight the Fed. If you don't, then don't fight the Fed. But the Fed doesn't position themselves appropriately. Instead, what do? They do a freaking tour. They do an interview tour talking about how they're not really sure about future rate cuts. And that's why we're down to less than 50% probability for December rate cut. The only good thing with this is that it creates potential upside. So if we do get the cut when the market wasn't expecting it, that will be good. We'll see rates drop as a result of that. If we don't get the cut, though, that's still problematic because we had a 50-50 chance to get it. So that would get unwound a little bit and it would actually hurt us if we don't get it. So these are things that are difficult to understand for most people. And that's the reason why I wanted to go through all this stuff, get it all out there. That's all I have for now. I got to get back to work. My inbox is filling up. Hopefully that's helpful for you guys. Just be careful. Be careful with where you're getting information from these days. It is, I don't know. We've got a lot of chiefs and not enough Indians or something like that. I don't know, right? Have a good day.